I have been a long-term critic of China. It's always a matter of public record on the tape. And I think the president is doing exactly the right thing here. This should have been done years ago. The world trading system is broken. The World Trade Organization is broken. We just had this discussion at the G7. B, the biggest culprit is China.
That was President Trump's top economic advisor, Larry Kudlow. He was speaking earlier today here at the CNBC Institutional Investor Delivering Alpha Conference, blaming China for the world's trade problems. Given the tensions with the two countries, is it still safe to invest in China? Joining us is Helen Zhu. She's head of China equities for the Fundamental Active Equity Group at BlackRock. Good to have you here.
Thank you. Good to be here.
Before we went to break, we showed the significant outperformance of the U.S. market versus the Chinese market. Chinese market's down like 12%, and at the same time, the U.S. market is up more than 2%, perhaps 4%, depending on which average you look at. Is that because of trade tensions, or is that something else?
Well, I think it's really a combination of two things. In reality, the on-the-ground fundamentals for the economy are still fairly robust. You know, we saw 6.7% GDP growth posted in the second quarter. But looking forward, people are worried about not only the uncertainties related to the trade situation, but also, very importantly, there is this concern that the policymakers might over-tighten into an uncertain export environment because of the financial and corporate deleveraging agenda that the policymakers have put forth. And so I think it's those two concerns compounded together that's actually hit the A-share market particularly hard in the past few months.
And to be clear, you're talking about the policymakers in China tightening too much, correct? Because we talk so much about, we're always talking in an American context.
Correct. A lot of leverage has built up in China over the past few years, and the policymakers since last year have been talking about the agenda of basically removing some of the shadow banking sectors within China and also potentially lowering leverage overall over time. So I think the domestic investors have been very worried about the particular liquidity impacts on the A-share market, given that it is still a largely closed capital account and fairly insulated. So I think that concern has actually compounded the negative returns this year in the A-share market versus, you know, if you look at offshore China, it's down a lot less versus the onshore China market.
Are you as worried as the domestic investor appears to be? I mean, is that performance justified based on the fundamentals that you see, or would you say that that market in China has overreacted?
You know, I would actually think that in 3, 6, 12 months' time, we'll look back and think that the market has probably overreacted. The domestic market is very retail-driven, as you probably know. So whenever there is any sentiment shift, it can generally overreact in one direction or another. I do believe that the trade war situation will continue. As, you know, you showed on the clip earlier, indeed, it's a situation that's unlikely to be diminished immediately, although I do think that both sides have incentives to come to some kind of reasonable compromise because American corporates and American consumers are taking a hit to some extent as well. But I do think that people are being too pessimistic if they feel that the policymakers are going to make a very significant error in terms of facing the trade situation and uncertainties, but at the same time also over-tightening. In fact, over the last couple of months, we've already started to see some mild fine-tuning of policy stance towards stabilizing expectations, making sure that systemic risks do not erupt, making sure that reserve ratios are adjusted, you know, basically closing the back door in terms of shadow banking and a lot of illegitimate credit supply, but also opening the front door to more transparent channels.
I noticed in your portfolio, you know, you don't seem as weighted perhaps towards some of the big export names, Alibaba, Tencent, Baidu, all plays on the Chinese consumer. I assume you're still confident that that consumer is strong?
The consumer side is doing very, very well in China still. And those, you know, larger players in the internet space have been gaining market share over the past couple of years as well. In fact, I think the policymakers are pleased to see that over time, China can hopefully reduce the reliance on exports and reduce the reliance in terms of infrastructure investment and property sector. So there's been a lot of relatively tough policies towards those. But in terms of the domestic consumption picture, confidence is still very strong, and the fundamentals are still very, very good from what we can see so far. And I do think that there is going to be more policies like this to support, for example, recently personal income tax cuts. I think those types of policies will continue to be introduced.
Everybody loves an income tax cut, right? No matter what country in the world you live in. Helen, thank you. Good to have you on. Helen Zhu is with BlackRock.